Octopart is the most trusted search engine for electronic parts. Search across hundreds of distributors and thousands of manufacturers. See up-to-date stock levels, part costs at different amounts, and technical specifications with each search. Start searching today.
Hey everyone, thank you so much for joining us today. This is the first of what we hope will be many of these webinar series. My name is James Sweetlove, I'll be the host. Today we're going to be covering a couple of different topics. Some of the key ones we'll be looking at are uncovering the supply and demand dynamics shaping high-performance analog, passive, and discrete, as well as interconnect markets. We'll be looking at navigating the ever-evolving landscape, gain some insights into supply chain inventories, industrial and military demand, AI advancements, semi and passive outlook, and automotive as well as interconnect trends. And lastly, we'll be looking at how to stay ahead of the market conditions for 2023, how to master the art of analyzing and interpreting market trends and making well-informed decisions. So I am the host, but today we have two guest speakers. We have firstly Daniel Schoenfelder, head of Octopart. Dan brings an impressive 20-year track record in the world of electronic components, digital leadership, distribution, and manufacturing. He's been privileged to occupy the roles that offer extensive insight into supply chain, operations, sales, and digital strategy. His current position is as the head of Octopart, where he drives the Octopart team and his dedication and democratizing electronic components, data, and expediting decision-making for engineers, designers, and buyers. We also have Dennis Reed, who is a senior analyst at Edgewater Research. Dennis has extensive experience working in research in the technology, semiconductor, distribution, memory, and HDD industries. Dennis also brings a wide level of experience working in various other industries like insurance, business unit growth, and targeted end markets. Currently a senior research analyst in technology at Edgewater Research, Dennis focuses on trends in the automotive, defense, semiconductor, analog, and passive markets. Thank you both so much for taking the time to talk to everyone today. We really appreciate you both being here. Welcome to the webinar.
Thank you very much, James, and appreciate everybody dialing in. We've got a lot of information between Dan and myself to cover today, so I'm going to jump right into it. And to start, the first question that we often get at Edgewater is, what does this cycle compare to? And it is an interesting discussion, and we've tried to chart it out. So peak sales for our industry was October of 2022. I think everybody knows that. And the real question is, where do we go from here? To start, it looked like we were following the 2000 correction, which obviously is troubling. But more recently, we've seen that flatten out and does lend itself to what I would say is shaping up to be a more shallow, longer lasting correction, which is good news to some extent. While I would tell you that our work would point in history has shown us that median peak to trough in sales is roughly 8 months, that puts us where we sit today in the July-ish, August-ish period is finding a bottom. So again, that's good news. In terms of the shallowness of this correction, we're tracking somewhere down 10%. Peak to trough, again, which is shallower than the median peak to trough going back to 1990 at 13.5%, 14%. So again, good news there as well. But what I would caution everybody on the webinar with is the time to reach peak, to re-reach our peak sales. The idea initially with this correction is we've gotten too much inventory. It's going to be a V shape. 1Q we burn, 2Q we level, 3Q, 4Q, we're off to the races. And quite simply, I tell you, history has not seen that. And as we'll discuss further, book to bills, booking, and inventory also is not showing that. So, you know, what I would caution everybody is the median months to hit a new high or to at least return to those peak levels has been 23 months. And with this cycle tracking eerily close to 2011, it was 25 months until we reached that peak again. So again, while the ultimate downturn was not as severe as you would think, I would caution everybody, and I think the overarching message is plan for the worst and chase growth to the upside. Our take is really you're looking at probably an October-ish, somewhere in that range next year that puts you in that 23, 24 months. So again, shallow and longer is the way that we're looking at this cycle. You know, and the cycle hasn't been started or hasn't dealt with, obviously, at certain levels of disruption, and we're all familiar with these, from geopolitics to natural disasters, COVID outbreaks, port congestions, material shortages. And when that wasn't enough over the last 2 to 3 years, we've been hit with not one, but two, actually three, no, I'm sorry, 4 banks that have filed here since March 1st. And honestly, the scariest thing to us from the banking side, and by no means are we banking or credit analysts, but the scariest side to us when you think about this is Silicon Valley Bank was actually bigger than Lehman Brothers, and we know the fallout from Lehman back in 2008, 2009. So in aggregate, these were all bigger banks than Lehman, and so far we've been able to move through and kind of power through this without really any major hiccup in our industry. So why does it matter? When you look at what caused the banks, and again, we're not interest rates, we're not credit analysts, but everyone talks about the word unprecedented and how unprecedented the rise in interest rates were. You know, when I look at this chart, and this is interest rates, you know, the effective Fed funds rate dating back to 2000, so roughly 23 years of data, you know, there's a couple of things that jump out to me. And one is, we've been at this level before, and if I were to draw this chart back another 20 years, realistically, the unprecedented levels of interest rates are how low they've been. But I would leave you all with one, we've been there before, one, and two, every time we've reached this level of an interest rate environment, it's led to a recession. And that's problematic to us, and something that, again, leaves us a little bit more caution at the margin from the highest point looking at our overall economy. But what does it mean at a more micro, at a more company level? And this is where I think it becomes really interesting for our industry. On this chart, we're looking at the distribution, the two major distributors in their day sales outstanding. So really their ability to pull in their revenue or collect their revenue from their customers after a sale. For distributor number one, going back to 2001, they've averaged 82 days. Right now, they are hovering at 114 and change. That to us is problematic when the cost of money has gone up. We've seen more and more instances in our work where various customers, various channels, EMS in particular, have looked to extend payment terms. They've looked to stop receiving products as inventory has been elevated. But any way you cut it, as we look at this, you know, just with distributor one, but even distributor two, they're getting paid slower, and that creates a problem in terms of their overall financial metrics and how they operate their businesses. Along with that, they're also sitting on unprecedented levels of inventory. And I'll be the first to admit, this inventory data is backward looking. So this is as of April 1st. April 1st of this year, so the end of the first quarter. But there's a couple of things that jump out to me globally in this $272 billion of inventory. You know, one, we've heard throughout this shortage, there's no products, inventory's lean. And when you look at the dollars of inventory in the bottom, that's unequivocally false. Inventory dollars are at record levels. That does not mean throughout this entire upcycle the inventory was right, the golden screw phenomenon was right, it is improving, but inventory at really no point of this upcycle has been what I would call lean. We have been running at very, very high levels, and it has continued to build up until recently. So to normalize with that, and the reasonable question is, well, it's all been price, and price is certainly factored into that inventory dollar number. We also look at the days of inventory levels, and unfortunately, the days of inventory exiting the first quarter are actually worse than the dollars of inventory. And that's a function of sales have started to slow, but inventory has not come down fast enough. The good news, when you look at inventory, we have seen progress at the OEM and the ODM level. So we are seeing the guy in EMS, I should say. So we are seeing the guys who are building and holding components. We are seeing them making progress. We have not yet seen that flow through to distribution. And then when we look at all the supplier base, they are sitting on very elevated inventory levels, which again, I would argue if you want the inventory parked anywhere in the supply chain, it's arguably at best with the supplier standpoint than downstream. But again, inventory is way too high right now. And I'm sure that's not a surprise to anybody on the call. As we look at how we've gotten there, unfortunately, our industry can't help itself. It's cyclical. So when we look at the CapEx for the semiconductor market and the passive markets, you know, at least dating back to 2015, a couple of interesting things that jump out to me. 2020, 2021, and 2022 were the only 3-year windows going back to 1998, 99, and 2000, where you saw 3 straight years of double-digit year-over-year capital spending increases. And unfortunately, we all know how that ended. So again, reminding everybody from the cycle call previously, we don't think it's that type of a correction. But again, we have clearly spent way too much, and there's too much capacity coming online. The next logical question to us is this has obviously been driven by the compute suppliers. We know the memory supply chain in particular had been very aggressive through COVID. We also know the foundries have been very aggressive through COVID, driven in part by Taiwan Semi and their plans to spend $100 billion over the next 3 years. So we've stripped that out. And oddly enough, the data actually looks worse, which was interesting to us. And so when I look at this, a couple of things jump out to me. One, and it's worth noting, this data is somewhat skewed by one very, very large, the largest analog supplier based in Dallas, Texas. They do account for a bulk of the spending. They are marching to their own business plan, which is effectively trying to double their revenue capacity for what they see as their demand in 2035. So again, I would mark that some of that year-over-year increase is driven by one company in particular, but I would also leave you with the commentary or the feedback from the suppliers that we're in a massive shortage, we will never have enough capacity, et cetera, et cetera, et cetera, is unequivocally false. When we look at our history over the long term, sales do actually go up and to the right in a linear function. Unfortunately, the capital, or I should say the capacity, is much more of a step function, and we have entered into a period where we've overshot demand and we need to grow into it. As we flip from the supply side and we look over to the demand side, it's easy to see how we ended up with the supply imbalance. And I'll start at first with the PC market. And it really is the easiest one, but I think encapsulates a lot of what happened across the overall industry. Prior to COVID, PCs were a 275 million unit market per year, growing plus or minus a couple million. It went from 275 to 300 to 330 to 293 million last year. So in a total of 3 years, we have shipped roughly 100 million units above the historical trend line. And unfortunately, as we've pulled forward that demand, we're now paying for it on the downside. Edgewater's forecast for this year is somewhere in the 250, 255 range. The good news is we've seen some stability in PC orders at the component level. We've also seen very, very near term, we've seen some positive trend from at least in a North American sell-through with Prime Day last week. So we are seeing some signs of life, but by and large, as we look at the PC market for the next several years, we think we need to quote unquote digest 100 million units. Or another way of saying, we're looking at somewhere of 2 to 3 years to basically undership that 275 million number before we return to more normalized growth levels. As we shift to server, it really is a story of what I would say 3 markets right now. And to go through the 3 markets, from a cloud standpoint, it's depressed. And the cloud providers had dramatically and opportunistically built their capacity during the COVID years, and for certain understandable reasons, as more and more opportunities shifted to the cloud, they operate in an environment where they maintain a utilization level. They need to be able to flex up to meet max capacity, and we're at a period right now of simple digestion. And then you factor on some of the macro concerns, and it might be a little bit more of a prolonged digestion. We don't see any dramatic change from an overall cloud trend, but I would tell you right now, we're in a cloud capacity digestion phase. When we look at the enterprise, it's very, very easy to see. The enterprise, in particular, the on-prem, it's been underutilized as people shifted home, and then you factor in macro concerns. So when you net those 2 markets together, you're looking at somewhere of 750,000 server unit decline this year. Now, the next logical question, and a very good question, is, well, what about AI? And I would tell you that AI is certainly exciting. AI is an arms race. AI is good for several suppliers. But unfortunately, we're looking at AI units going from roughly 85,000 units last year to 175,000 units this year. So from a pure mathematics standpoint, the AI volume is not enough to offset what we're seeing in core data center, what we're seeing in the enterprise, most notably around the x86 architecture. And to put some additional numbers behind it, and why I would tell you this is important to weigh cyclicality versus structural growth, this is our forecast for various product families or technology categories for AI extending out into 2030. And to be perfectly clear with everybody on the call, these numbers have not changed despite our overall server unit number coming down repeatedly through the year. When we look at the AI spend, we are looking at a market that just 2 to 3 years ago was a sub-billion-dollar market across the networking, storage, and processing side that has the opportunity to be approaching 100 billion units or $100 billion by the end of this decade. The growth is remarkable. I think within that, there's some very, very realistic use case scenarios that need to be figured out. And that is a risk as we work through to the forecast. There's also the monetization side of it. Right now, what I would say in the current form, as impressive as the ChatGPTs and the other LLMs are, the use case cannot simply be helping college kids write papers and not do the research themselves. But what I would say is when you get into theoretical conversations and you look at these types of technologies, proliferating into IoT, making its way into the industrial markets, being more centered on factories that are using and analyzing their own production areas, looking for efficiencies, process improvements, etc., then the technology becomes real. And then that 100 billion-ish number in 7 short years from now very, very much seems doable. As we switch gears very quickly to the cell phone market, unfortunately, the only real message here is we're in a year of depressed demand, and most notably depressed demand from China. For cell phone forecasts or smartphone forecasts, I should say, have been repeatedly cut year to date. We've got it by OEM, so I won't delve into that on the bottom. But what I would tell you is we're looking somewhere down 4 to 5% this year, and then hopefully stabilizing from there. So we do think, broadly, the cell phone boom is probably over, or the smartphone boom, I guess you should say, is probably over. You're in a much more mature marketplace where you're looking at playing upgrade cycles versus really, truly installing a large base like you did in China over the last several years. As we shift more to the industrial North American, Western world focused markets, I'll start with automotive here. And the good news from an automotive standpoint, production this year we have up slightly in the low 80 million range. So that is good news. Last year, production was down slightly. It was negatively impacted by golden screws, things like that. Those are all by and large alleviated. So the golden screws are alleviated. The good news is production looks controlled and up marginally, I would say, this year. The bad news with that is some of our tailwinds that we had in previous years are also gone. Dealer level inventories in North America are at 55 days. They bottomed out at 19 days, a little over 18 months ago. So we've refilled the channel at the point of sale. They were 90 days, 80 days, 90 days prior. We don't think you're ever getting back to there. So you don't have a tailwind, I would say, from an inventory replenishment or a channel fill of vehicles, one. Two, you have mixed challenges. The composition when I talk to demand has been largely driven by fleet vehicles. Those are very, very nice cars from whoever's rented a car recently, but they typically aren't as feature rich. And I would also say the inventory is much heavier on luxury sedans, luxury SUVs, and it's very much under for your less premium, less electronic intensive vehicles like mid-size compacts, etc. So we do have a mixed challenge this year, and I would say lastly, we have an interest rate slash we've all been on allocation pressuring the mix. The good news to date, the auto industry hasn't reacted with MSRP or additional rebate action. So they seem to have found somewhat of their religion through COVID. But again, with interest rates high, we'll see how long that ultimately holds. As we shift to the demand side within automotive, again, a lot of good news here. Forecast to start the year were around 15.5 million units for the SAAR in North America, and that is up from 14.25 last year. And to date, slightly over the midway through the year, we've actually held that number. So that is good news. As I mentioned on the previous slide, that is being largely driven by fleet. So we aren't getting a unit plus mix kicker in the industry, but we are getting some level of goodness from the unit. And also it is a much different trend than what we've seen over the past several years, as we've seen the automotive electronics industry in particular really outperform the SAAR or global production. As we flip to industrial, a couple of things that I would highlight here for everybody. First of all, at the highest level in the US, we've gone negative, unfortunately, in May. So I think it's important to somewhat black out the wild swings with the COVID years and the recovery from it, because that's simply mathematics. But when we get into a more normalized year, we've seen overall manufacturing in the US continue to slow, and I think that's largely macro driven. That doesn't change the industry specific dynamics, whether it's robotics, whether it's electrification, whether it's energy efficiency. All of those are still tailwinds for the industry, and all of those will continue to drive content growth. But the way we're thinking about it, as you boil it into our industry, if you were in an environment where the total manufacturing grew 4 to 6, you could think of factory automation growing 6 to 8%. If you're now in an environment where where it's call it flat, you're looking at potentially 2 to 3 low single digit type growth, because again, you're just not seeing the manufacturing as robust as it was, one. And then two, if you think back to the interest rate slide earlier, just the cost of doing business is higher. So we do think there will be a certain level of caution as it relates to industrial CapEx moving forward. Not to talk too much on this, but also wanted to strip out transportation just to show how much transportation is impacted. Transportation is driving, call it 3 points of outperformance relative to the broader market. So you're still seeing better relative trends from automotive, as I talked about, from rail transportation, from aerospace. You're still seeing relative robustness in those markets, but again, they're just not enough to pull the entire manufacturing base positive here in the US. As we shift to defense, in what I would tell you with these two slides in defense, one, we're in a long-term secular upswing in defense spending, and that's probably not a surprise to anybody here. If you look at the chart on top, it has been largely up and to the right if you draw a trend line to it. But what I would tell you too is more important. It's not that the spend is going on, it's what the spend is being directed at. The Pentagon and all of their budgets, they are focused on the war of the future, not the war of today, and not making light of the humanitarian crisis in Ukraine, but they are entirely focused on what the war of the future will include, which will be much more digital. It will include satellites. It will include hypersonic missiles. It will largely be fought over the Pacific Ocean, unfortunately. As we flip quickly to the healthcare market, what I would start at the highest level from a healthcare standpoint, unfortunately here in the US, we're getting older, we're getting less healthy, and we're getting fatter. So the demographics are clearly favoring overall growth in terms of medical spending here in the US. How does that translate into electronics? And as everybody I'm sure is very, very well aware, the medical business is largely project driven, largely market driven, and we've seen that. We've seen a mad run on ventilators, we've seen that turn to out of office home healthcare, and now we're returning to more of the traditional programs. So just to give you an idea of one forecast from a global medical device sales, in 2020, so a mere 3 years ago, that was a $456 million market. Again, in 10 years, it's expected to almost double. We could go through and put the same charts, but in the interest of time, not doing for MRI devices, various imaging, various home programs. So again, we look at the medical market is a long-term mid-single-digit type growth opportunity. It's a very, very healthy, robust, and by and large, we've returned to the quote-unquote new normal, which the new normal happened to be the old normal pre-COVID. As we wrap up quickly, just to touch base on our forecast by semiconductors, passives, in the interconnect marketplace. For semiconductors, we have the year at down 12, and that's largely driven by memory that we have down 35% for this year. When you back memory out, that number looks closer to 5 or 6%, much more in line with kind of that cyclical correction. The delta, I would say, in our outlook relative to other competitors or market prognosticators, if you will, is for next year. Most are calling for a significant snapback, where we still think there's too much inventory, one, and it's going to take two, a lot longer for it to burn. So next year we're up 3, where most others that we compete with are up in the double-digit range. As we flip to the interconnect marketplace, a very, very similar story. We actually have the growth number down 4.5%, 5% for the year, and really the only delta from that has been they weren't as tight, as fast, or as long as the semi guys, so they've corrected quicker. Long term, we think the trend for interconnect is very, very positive, kind of a mid-single 5-6% growth, largely driven on the back of EVs and the AI, which are two markets. That one market we touched in detail, but I could go on and on about EV and the opportunity there as well. And then to round out with the passive side, what I would tell everybody is this is the market we're the most concerned. Our forecast is down 9 for the year. The reason it's lower is, one, these products are simply more fungible or interchangeable, so there's more competition. And two, the pricing outlook for the second half is much more aggressive than what we're seeing from an analog standpoint, a high-end semi standpoint, but also as well as the interconnect standpoint. So when we rank order our optimism in terms of getting through this recovery the quickest, I would say we're the most concerned with the passive industry. Then we're secondly, I would say it is the interconnect, just because they typically don't get the ASP lift with newness that you see in semis, followed by we're the most optimistic coming out from a high-end semi side. So just to conclude from the Edgewater side, what we see at the high level is, again, fundamentals have changed. We've gone from just in case to just on time to just too much inventory. So there is a lot of product out there. We are seeing the consumer PC, smartphone end markets. The end demand has slowed. We do think it's a pull forward. And then the industry is not fundamentally broken. I've touched on a couple of cyclicals for structural changes. And again, I think that's important to think about right now as we continue to work through digesting the inventory levels.
Hey, so first I'd like to start off by saying I really want to thank Dennis and the partners at Edgewater for spending some time with us here today. I think that we have a burgeoning, I think, both friendship and partnership with the guys at Edgewater. We think they're doing some very interesting things in our space here. And they're bringing some interesting perspective and data to us that I don't think is native to how we think about our business, particularly at the component level. I do want to then jump into some of the perspective that Octopart has on the market. Octopart does have millions of sessions that happen on its site per month. We process a lot of electronic component data and feel that we're situated in a place in the industry that we can provide some insights and some intelligence around what's happening, particularly at the component and category level. I think to reiterate what Dennis is saying, that we're in a much different economy right now than we were a year ago and we were 2 years ago. I think Dennis used the euphemism that of this being a cyclical or cycle that we're in, that I like to say that the electronic component space is very poor, does a very poor job at soft landings after things go well. And that's, I think, the circumstances that many component manufacturers and distributors find themselves in right now. I think that from our perspective, the world of predictions right now is one that's incredibly hard to be in. When it comes to what can the components industry expect in the near term. I don't think that we've ever seen a cycle, particularly for semiconductors, that we saw over the last 2.5 to 3 years. And how we rebound from that is proving to be very hard to predict. And given where we are in a state of either a trough or slight recovery, it's very hard to know at this point in time. But what I would say too is that all the partners and all the companies that we work with from an Octopart perspective are very bullish on the future. They do think that the 18-month plus forecast for their businesses is something something that will they're very positive about. So, Dennis, do you mind going to the next slide? I want to share just a couple slides on some data that we collect inside of our business, along with one of our sister businesses. It's called Spectra. But at Octopart, again, we have a tremendous amount of adoption, a dedicated user community that is searching for electronic components and devices, and looking to do research on components, on where they can buy them, looking to see, compare specifications of devices, and find the information they need, whether it's data sheets or CAD models or inventory and pricing availability, et cetera. So we get a pretty good signal when it comes to what does the supply look like in this industry. And Dennis finished off his slides by talking about 3 specific categories: and interconnect, integrated circuits represented here. Dennis talked about them as semiconductors, but then also passive devices. And what you're seeing here is our index for the supply of those 3 categories going back to January of 2019. This is an index. You'll see that all 3 of these lines intersect for the first time in January of 2020, and that's actually the baseline of the index that we're looking at. We developed that index with that baseline because we felt it was the closest point in time that any of us recognize is somewhat normal before the pandemic hit. But what you'll see in this data is, I think, not a surprise to anyone, that over the last 18 months or so, inventory levels have risen dramatically across all of these categories of components. And so right now, it doesn't look like the end is in sight, particularly for semiconductor products, but we have seen passives peak out sometime in early 2023 or late 2022 in terms of market availability of products. Do you mind going to the next slide, Dennis? And I think that comparing that to the demand signal that we have for these same categories is something that's quite interesting. Where the demand signal from our perspective is a normalized view of what are users looking for, what are they searching for, what are the parts they're clicking on, what is driving the most interest in the market. And so I think to me, what's interesting, if you compare this chart that we're seeing now with the prior chart, is that there was a tremendous change in the demand for semiconductor products that we saw over the last couple of years. But we did not see the commensurate change in demand. We did see some, but not commensurate with what you're seeing for interconnect and for passive devices as well too. But we are seeing the resultant the resultant inventory buildup in the channel, in particular for passive and connectors. So, from our perspective, we're seeing this pull through of semiconductor devices and the impact that they're having on other related componentry that's utilized in similar designs as well too. What I would say as far as the near-term projection from our perspective is concerned is that we do see strong demand. So if you look at these demand indices and compare them to pre-pandemic levels, it's extremely strong relative to that period in time. And we think that is going to, I think as Dennis noted, keep this a very shallow sort of a macroeconomic circumstance, and that would be a shared view that we have as well too when we're thinking about it at the component level. And so from our perspective, I think that that our data and the Edgewater data is very complementary to one another in terms of the narrative that we think it shares on where we are in the industry.
Excellent. Thanks, Dan. Maybe just to wrap up, and I think a lot of these we've touched on in both, but these are, you know, some of the hot button issues that we're watching here at Edgewater. And you know, I touched in particular on the LLMs. It is what is the use cases? What does it have on CapEx long term? You know, so far it's only been driven by GPUs. How does this infrastructure, you know, how does this infrastructure, this architecture ultimately play out? And then again, you know, what I would tell you is it's an arms race right now. And again, when you think long term, we just got out of the last arms race with the metaverse, and it's a completely different discussion, Dan, on how real or virtual legless avatars are versus face-to-face meetings. But again, right now it's new and it's exciting, and you know, I could give you some one-offs that are pretty shocking. You know, the China trade war escalation, I won't go through all the questions, and everybody's probably seen the updated rare earth metals. It continues to escalate, and that's really concerning. It's a key, I'm sure, and Dan would agree. It's a key. The China plus one strategy is very much real. How do we solve that in an industry is also a very, very real problem. And then lastly, when we look, you know, well on before, historical cyclical trends have been really kind of thrown out the window when it turned to pricing, second sourcing, things of those nature. You know, when we get through the shortage and the subsequent correction, and you know, I know the team at Octopart has tremendous insights into this, but when we get through this shortage and then correction, what does it look like from a design going forward? Are we looking at more second sourced opportunities, dual source? How does that process change, and how do customers ultimately manage through it? Again, along with the long-term pricing curve, where customers want to go to historical and suppliers want to never lower price again. So very, very interesting dynamics that I would say, in questions that at this point we actually don't have the answers to. So I'd say with that, we could pause here and see if there's any questions for either Dan or myself.
Yeah, just before we get into the questions, just wanted to let everyone listening or attending know that this video will be out on the 24th. So if you missed part of this, attended late, or you know someone who signed up who couldn't be here today, we will be sending out the full seminar for you to watch and listen to on the 24th. We do have a couple of questions though. Dan, the first one is actually for you. They wanted to know, what user behavior do we see now based on market conditions versus what we saw during the peak of the pandemic?
Yeah, that's a great question. I think from an Octopart perspective, we're seeing there's several use cases for Octopart, whether it's an engineering workflow that's concerned more about the specifications of products, their availability of CAD models, the data sheets, et cetera. And then there's also some supply chain workflows around the price and availability of components. And we're seeing much less activity today for those supply chain workflows, but we're seeing a consistency of activity on what we would consider to be more of an engineering workflow. So it's been interesting to see that mix change as I think inventories have risen, as component availability has stabilized over the last 12 months.
Great. Dennis, the next one is for you. They asked, the pricing environment has been strong across most or all components. What's your outlook for pricing in 2024 and beyond?
You know, great question. And I touched on, you know, I would say the longer term curve of that is the one that we honestly don't have an answer for at this stage. You know, to address the longer or the more near term for 2024, Historically, we operated, as most know, any customer throws out a request for concessions, and they would typically land somewhere in the 2-3% year-over-year declines, and everybody moved away happy. When we look at it next year, most, if not all, of the OEMs are looking to at least double that rate of decline. So they feel that they have paid way too much through the upcycle, and they're looking at their best to claw as much back. So, you know, they're asking 5-6% plus. We think the supplier base is coming in more with an eye of flattish. And we think, you know, where it ends up landing, we do think it kind of falls more within that historical range of probably down 1 to 3%. What I would say, there is somewhat of a change, probably more materially, where you are seeing more horse trading, where you're seeing more market share, more opportunities being put out to bid for future business, starting with next year and beyond, that ultimately there is price concessions built into those.
Great. Dan, there was one for you that I just wanted to know if you had any additional insights into the China situation, anything you'd like to add there?
You know, I think that this is going to be an interesting one that's going to play out over several years. Dennis touched on this a bit, that it's not going away. This is a circumstance we're all going to have to manage to. From my perspective, I think that we're going to continue to see a little bit of an escalation of policies that are going to lead us into a much more segmented approach to how we're sourcing and regionally, and it's going to have some major implications on global trade. But I don't think we know the extent of what that's going to be, and it's going to be really hard to project that over the next, say, 12 to 18 months.
Great. Dennis, I want to know, outside of AI, are there any other LT growth markets that we should be focusing on?
Sure. So, you know, I think the biggest one, and I touched on it a little bit without going into detail in this presentation, is EV. So when we look out and look at the market, I highlighted how AI has the potential across networking, processor, and storage to be a $100 billion market by the end of this decade. You know, EV is somewhere that has a content growth plus a unit growth story. To talk on the unit just quickly, units were 1 million units in 2020. I think they were 1.7 last year. They're probably going to be 2.5 this year. And we're at about 54 million by the end of this year. And then when you think of the content, your standard internal combustion engine vehicle is about $500. That goes to $700, $800, maybe $900 for hybrid, and you're $1,500 plus, right? So if you assume that 1,500 stays flat and you get to that 54 million unit number, that puts you at an $85 billion marketplace by the end of this decade. If you assume that content triples, which I don't know if that's right, wrong, or indifferent, but that puts you north of 250 billion by the end of this decade. What I would just say is, if it's 80 billion, that's great. If it's north of 250, that's super duper great, right? To really pull a technical term out there. So, you know, that's probably the biggest one that we see outside of AI for the next, 7+ years.
Great. Final question here. It's actually for both of you. What do you see the role of analytics and data analytics specifically being in the coming years?
Dan, do you want to lead off?
Yeah, I'm happy to. You know, I think that one of the things that is that I think has become apparent is there's no entity, whether you're a distributor, a component manufacturer, an OEM, whether you're a research firm in this industry, that is going to solve problems in a bubble by themselves. I think that every organization is going to have to build their network of partnerships, their network of information in order to be successful. And so I think the companies that figure out how not just do creative things with data, but doing creative things with data that is outside of their native data sets are going to be the ones that have the largest advantages. And so What I would say though is also data is something that's a little bit of a magnifier as well too, in terms of it's something that in and of itself is not helpful, but it's something that if you do great things with it, can really be a changer for your organization as far as allowing you to scale, make better decisions, et cetera.
No, I would echo a lot of what Dan said, and I would also add a few things. I think what we've learned, the absence of data market intelligence is very, very expensive. And there are several key OEMs and or industries that their lost sales or profits are in the billions of dollars from not being able to buy components. And not saying data or analytics fixes that, but that knowledge helps, right? So it's going to be, I think, an evolution, as Dan touched about, internal data, which I think to some extent I would argue we've used a little bit with KPIs and things like that, but how do you infuse that internal side with external market data so that when you make, whether it's a go-to-market decision, when you make a purchasing decision, especially in some of these newer industries that are becoming electrified, if you will, our traditional markets, when we think of the compute suppliers, they've been buying components forever. They understand the cycles, right? But when we think of some of the new ones, your industrial customers, your automotive customers, their history is in steel, leather, things like that. Now we're talking semiconductors, passives, different suppliers. They're competing with different people for allocations. And I think they're going to have to find a way to look at their own internal data, which is KPI driven, and then ultimately marry that with external data and market signals, or else the cost of not doing that is substantial. And we've seen that cost play out over the last 3.5 years.
Great.
Yeah, if I could just have a last word on the data piece too, is I think it's quite telling that that we're finding ourselves coming out of the biggest supply chain crisis of our lifetimes. Probably will end up being the biggest supply chain crisis of our lifetime, and some of the most horrific circumstances for the availability of electronic components. And throughout all of that, we were in a circumstance where there was greater data availability at all of our fingertips than there ever has been before. So it really does rely upon the application of that information and how it's utilized to solve problems at the end of the day. So, but we're not going to be short on data availability. I think that's going to be there. I think it's going to be deciding what's most impactful and applying that in the right ways.
Fantastic. Well, that actually brings us to the end of the seminar. Just wanted to say to everyone who's attended, thank you so much for your time and joining in. If you have any questions for Dan or Dennis, there are some slides that will be included when you get the post-attendance email that have their contact details for both of the companies as well. And if you want to learn a little more about some of the topics that we've covered here today, Octopart actually has a media hub called The Pulse that publishes articles, seminars, that sort of thing, that has a lot of fantastic content relating to these topics. So thank you again for everyone who's attending, and expect an email on the 24th.
Thank you, everyone.
Thanks.